Really, what is a 401k? Will one help you in getting towards retirement, at least the retirement that you desire? You probably have learned a little bit about them as an entrepreneur, but you don't know how to take really that first step towards retirement savings and then also mitigating your tax liability. Yes, 401ks are great for both retirement savings and also lowering tax liability. In fact, generally speaking, when you defer money into a 401k, you get an automatic rate of return close to your tax bracket rate, roughly. You're thinking, huh? Yep. If you're in, let's say, the 25% tax bracket, let's just say that, and you put in $1,000, how much do you save? You guessed it, $250 immediately. Kenneth French with vastsolutionsgroup.com. We do tax finance and we use artificial intelligence to help entrepreneurs save lots of tax dollars and helping them get towards the retirement that they desire. I'm an author. I've been in the finance industry for about 25 years, write for Forbes, et cetera, et cetera. The list goes on. The company's been around for approximately 50 years and has clients all over the country. By the way, please don't forget to like this video and also subscribe to the channel. Lots of good stuff in this channel. By the way, stay tuned. You're going to get a nice little bonus towards the end. The main reason we're doing this specific video on this topic is because so many people contact us because they're running a 401k and frankly, they don't know the specifics of how to run it. Well, after this, you'll understand the basics and probably a little bit more, to be frank. A 401k plan is a qualified plan that includes a feature allowing an employee to elect to have an employer contribute a portion of the employee's wages to an individual account under the plan. The underlying plan can be a profit-sharing plan, a stock bonus, pre-ERISA money purchase plan, or even a rural cooperative plan. Generally, deferred wages, elective deferrals, are not subject to federal income tax withholding at the time of the deferral, and they are not reported as taxable income on the employee's individual income tax return. 401k plans are permitted to allow employees to designate some or all of their elective deferrals as Roth elective deferrals that are generally subject to any taxation under the rules applicable to Roth IRAs. Roth deferrals are included in the employee's taxable income in that year of deferral. Tax advantages. Let's go into tax advantages. Two of the tax advantages of sponsoring a 401k plan, they are employer contributions are deductible on the employer's federal tax return to the extent that the contributions do not exceed certain limitations. Elective deferrals and investment gains are not currently taxed and enjoy tax deferral until distribution. Types available now. There are several types of 401k plans that are available to employers. Traditional 401k plans, safe harbor plans, simple plans, etc. Different rules apply to each one. For tax-favored status, a plan must be operating in accordance with the specific rules. Therefore, it's important that the employer be familiar with the special rules that apply to its plan so the plan is administered in accordance to those specific rules. To qualify for the tax benefits available to qualified plans, a plan must both contain language that means certain requirement qualifications, such as the tax law, and be operated in accordance with the plan's specific provisions. The following is a brief overview of important qualification rules. Let's go over it. It is important not to, this isn't inclusive, totally inclusive. Traditional 401k plans. Now let's go over a traditional 401k plan allows eligible employees to make pre-tax elective deferrals through payroll deductions. In addition, traditional 401k plans, employers have the option of making contributions on behalf of all participants, making matching contributions based on employee elective deferrals or both. These employer contributions can be subject to a vesting schedule, which provides that an employee's right to an employer's contribution becomes non-forfeitable only after a period of time or immediately vested, depending. Rules relating to traditional 401k plans require that contributions made under the plan meet specific requirements. In order to ensure that the plan satisfies these requirements, the employer must perform annual tests known as ADP tests. I won't go over the specifics, or ACP, depending on the specifics, to verify that deferred wages and employer contributions are not discriminating in favor of highly compensated employees. Safe harbor 401k plans, now those are similar to a traditional 401k plan, but among other things, it must provide for employer contributions that are fully vested when made. These contributions may be employer match contributions, which are limited to employees who defer, or employer contributions made on behalf of all eligible employees regardless of whether they make any elective deferrals. Safe harbor 401k plans are not subject to complex annual non-discrimination tests that apply to normal 401k plans. Safe harbor 401k plans that do not provide any additional contributions in a year are exempted from the top-heavy rules of certain IRS codes. Employers sponsoring safe harbor 401k plans must satisfy certain requirements. The notices that they are required must be provided to every eligible employee and be given a written notice of employees' rights and obligations under the plan, and the notice satisfies the content and timing requirements. In order to satisfy the content requirement, the notice must describe the safe harbor method in use, how eligible employees make elections, any other plans that are involved potentially with the specific plan, that being the 401k plans. Also remember, there are these things called summary plan descriptions, which are SPDs, which outline basically the specifics of the plan in very simple to understand language. Then again, that certainly is a challenge. If you only knew, especially when sometimes these plans can be very, very specific. But anyway, an SPD is a summary plan description in normal language. Now, both traditional and safe harbor plans are for employers of any size and can be combined with other retirement plans. That's important to note. Now, a simple 401k plan is a plan that was created so that small businesses can have effective, cost-efficient way to offer retirement benefits to employees. A simple 401k plan is not subject to annual non-discrimination tests that apply to traditional 401k plans. As with a safe harbor 401k plan, the employer is required to make employer contributions that are automatically fully vested. This type of 401k plan is available to employers with 100 or fewer employees who receive certain compensation from the employer for the preceding calendar year. You have to check with IRS for specifics. Employees who are eligible to participate in a simple 401k plan may not receive any contributions or benefit accruals under any other plan of the employer. Restrictions on conditions of participation. Now, this is important. A 401k plan cannot require as a condition of participation an employee complete more than 1 year of service. Also, an automatic enrollment in a 401k plan can have automatic enrollment features that permit the employer to automatically reduce the employee's wages by a fixed percentage or amount and contribute that amount to a 401k plan unless the employee has affirmatively chosen not to have his or her wages reduced or has chosen to have his or her wages reduced by a different percentage. Now, these contributions qualify as elective deferrals. This has been an effective way for many employers to increase participation in their 401k plans, thereby taking care of the employees. These contributions qualify as elective deferrals. Let's go over some of the limits. Under the law, called 402G, those limits amount of participant that can be deferred on a pre-tax basis. Elective deferrals that exceed that section dollar limit for a year or are recharacterized as after-tax contributions as part of a corrective means, it's called ADM, then the employer can make matching contributions for an employee who contributes elective deferrals to the 401k plan. I'll give an example. A 401k plan might provide that the employer contribute, let's say, 50 cents for each dollar that participating employees choose to defer into the plan. As mentioned earlier, employer contributions may be subject to annual tests to determine if non-discrimination requirements were met. Other employer contributions, if the plan document permits, the employer can make additional contributions for participants, including participants who chose not to contribute elective deferrals to the 401k plan. If the 401k plan is top-heavy, the employer may be required to make minimum contributions on behalf of certain employees. In general, a plan is top-heavy if the account balances of key employees exceed 60% of the account balance of all the employees. The rules relating to the determination of whether a plan is top-heavy are very complex. That's why you need someone like us. Vesting requirements. Now let's go over this. All employees must be fully 100% vested in their elective deferrals. A plan may require completion of a specific number of years of service for vesting in order to get matching contributions. For example, a plan may require that the employee complete 2 years of service to get 20% vested in employer contributions and additional years of service for increases in vesting percentages. Now, after watching this video, I'm really hoping you understand kind of the basics and maybe a little bit more about 401k plans. Really, I hope you now have enough information before you so you can make informed decisions about 401k plans. Or, who knows, maybe you're looking to establish one. You want to just increase your general knowledge of retirement savings for entrepreneurs or tax savings for entrepreneurs, or maybe even employees, whatever the case. It's my hope that this has been helpful in some way, and I appreciate you staying this long. I said you'll get a nice little bonus for staying tuned. And again, thank you very much for doing so, since you made it this far, right? If you send an email to einstein@vastsolutionsgroup.com, we will send you a free copy of my book, and it's called The Entrepreneur's Manifesto, a collection of smart financial advice. Now, for disclosures, call the office at 888-808-8278. Now, thank you for watching this video, and if you need more information, you can also check us out on the web at vastsolutionsgroup.com, and don't forget to like this video and also subscribe to the channel. You're going to get a lot of good information as it comes out. Once again, thank you for taking the time. It's Kenner French with vastsolutionsgroup.com. Thank you for taking the time.